down today of exactly the procedure that I undertook to come to the conclusion of what the most probable direction was that the market was set up poised to push in relative to the 11th of October 2024 European morning trading session open. So obviously I've got the euro dollar chart open and the trade was relative to pound dollar, so I'm going to specifically go over that first. I'm going to stick some background music on too. So I'm probably going to do a lot of videos such as this because this is what I like doing best, because relative to the actual morning, I like to just kind of get up, then break down how the market's set up and, just basically do my Discord. I don't have a group, but I like to post my outlooks in of how the market's set up relative to each time frame top down in my own private Discord, which is basically my journal. So yeah, I follow AndrewNFX's market cycle top-down analysis approach, basically flow approach. You deal with the cards how the cards are set up today. So however, and what I mean by that is you deal with the cards that are dealt for you to deal with today. You don't impose what you want to see. For me personally, obviously, first of all, before I say what I'm going to say, you can do that. Some people that works fine. But for me, it did not work for me at all. And it just led to emotional disparity. Anyway, when I found AndrewNFX, I already had a hefty amount of experience. I'm been through absolutely fucking loads. And so I was able to differentiate or let's say discern between when Andrew was talking out of his experience versus when he wasn't. And then basically what I realized I had to do was break down, just basically look at every single one of his market outlooks and write down the exact steps he took to break down exactly how the market was set up to lead him to the conclusion of what direction the market was set up to push in over a particular time period, which is either European morning trading session or New York, which for me would be 8 o'clock. 3 o'clock. Anyway, I'm rambling a bit, so we'll get down into the breakdown. So I don't usually do this as soon as it was a Friday, the trade, but I'll do it just for this video. So as you can see, my charts are very clean. There's nothing on them whatsoever. And that's the same for every single one. GJ, I don't trade it. I'm just looking at it because I'm curious about the markets and best analyze Forex markets. But GJ, that's literally the NASDAQ of the Forex markets, in my opinion. But anyway, yeah, so I'll break down exactly how the market was set up. So as we see, the monthly chart was nicely overextended to the upside. Based on... I can't really conclude anything with the monthly apart from it being sat at the highs of an overall at-hand push to the upside, which was sat right at the highs, and there was already bearish momentum. But you would get more info if you just went down the time frames. So for this Friday, the highest time frame I was looking at was the 4-day, which I had recently added into my arsenal to look at too. Remember, I just flow with how the market's set up. I don't impose what I want to see. I literally deal with how the market's set up on each given day, and then with however it's set up on each given day dictates how I act or deal with the market, basically. So anyway, as we see this 4-hour bar close on the Friday. Now, the way this at-hand push was structured, angled, and where it was situated amongst the overall 4-day at-hand push, which for me, deciphered it, determined that it was from this low to this high. We were sat relatively at the highs. This 4-day push didn't look done pushing to the downside. Then if we go to the 3-day, it was the same thing. So the 3-day bar close on the Thursday. But remember, the momentum that's poised to unravel relative to the 3-day chart is likely to play out over the subsequent 3-day time period. So Friday is still very early on in this relative time frame duration. So the bearishness was still likely to prevail, and it was set up to do so, based on how this push was structured, its angle it was pushing in. It didn't look done pushing to the downside, so it was likely to head for around this low, which I still think it's likely to go to that low. Based on the structure of this bar. But obviously, as subsequent bars close, that like the direction can fluctuate, because if this bar, like, right, we're doing like proper classical AndrewNFX analysis here. If this bar closed something like this, right, this bar we're talking about, so if it closed something like this, the next bar could easily keep coming up. And then what you would do is to assess this push's momentum, which would be the subsequent at-hand push, what was in play, would be just keep tracking candle closes. And then how this at-hand push structure angle compares to previous at-hand pushes comprised within the in-frame chart perspective, compares with those pushes, momentum before they had topped out and reversed and moved in the other direction. So, like, for example, if the market was set up like this and this was the in-play bar fluctuating up and down, you would go just based on how the market was set up as of the most recent bar close, which what would be this. And if the market closed like this, well, first of all, the structure is not sufficient compared to this, so it's likely to keep pushing upwards, or more structure be added to the at-hand push, and then the angle, the angle the push was pushing in wouldn't suggest that the push is done pushing. So it would be likely to keep pushing. And then anyway, so like you deal with the market as a whole overall, and then like once you've determined the direction, you then start analyzing the state of that at-hand push, whether it's likely to keep pushing or just to keeping on track of how it's set up, analyzing bar by bar. So like if, for example, this bar closed bearish with the rejection, and then base time frames the next step lower, so like 2-day, daily, 12-hour also setting up for bearishness, well then the market's probably like to keep pushing lower, and then you would deal with how the market's set up again. So you get the gist a little bit, but I'm fully aware that this is completely experience based, and so yeah. 2-day bar closed on the Friday. Now, I was fully aware that the 2-day bar, where the market was situated relative to the 2-day at-hand push, it was situated right at the lows, at a small wick rejection, but didn't place much significance on that based on how the time frames, the next step higher was set up. Now, I also classify this as an overall, like, leg, because, like, for me, it, like, you would have, I don't even mark up my fibs anymore, I just kind of eye it, basically. But just for this video purposes, I will. So you get this, and then subsequent like fib pull occurs because the high that this fib range. No, see, like I also operate based on my subconscious. So when I'm doing this video, I'm somewhat having to describe certain things, and I can because before I got to the subconscious level of being able to operate out of subconscious, I had to go through a lot. But anyway, from this low to high, the low and high would define this leg. When it was broke past, from this low, the lowest point traded after this high was here, before it broke, right? Now, if there's a sufficient gap and sufficient time, like, in relative to 2-day time periods traded before this high was broke past, which there was, it would be valid to then look for a new at-hand push, only if this subsequent low, what we would be tracking as the market, as however participants traded, was like not too high up relative to the prior at-hand push, and anyway it was. So it didn't make sense to mark this up. It just didn't make sense. So what did make sense for me is to just go like that. And so I was eyeballing, and I still am. I don't even like marking up fibs. I just eyeball it, to be fair. So like from the low and high of the push, off the range, defining the relative time frame being assessed push, I then look to mark up a range, and I would probably look for the market to come down somewhere down in here. Anyway, as of Friday European morning trading session, the market, the 2-day push was a bit iffy, to be fair and be honest, because it was sat right at the lows. It was sufficiently structured. The angle was somewhat pointed for lower, more structure to unravel. Think of it like a piece of paper that's folded up, and it's likely to keep unfolding to the downside, because this push's structure looked like there was going to be more candles to it. Like more candles be added to it. Anyway, we dropped down to the daily, analyze how the market set up as of the Thursday bar close. And by the way, if you're wondering what this line is, it's just the EMA 100. Yeah, it's just the EMA 100 to assess the market's moving average relative to the open, high, low, close range of each bar relative time frame being analyzed. And what I've noticed is like when the market comes a bit like gets traded away from the relative time frame being analyzed, EMA, it tends to eventually come back, especially if like the structure of the push being analyzed is also looking like it's likely to turn over. So remember as well, like what our goal is just to determine the most probable direction the market is likely to push in over each time frame we assess, and basically determine the market cycle phase each time frame is likely to be in. Okay, so as of the daily bar close prior to Friday, it was also a bit iffy based on the wick rejection and being right at the very lows in this zone. But it didn't hold that much significance based on how the 4-day next step higher base time frame chart perspectives was set up. Still poised for lower, and especially with the weekly too. So yeah, drop down to the next time frame, see how that time frame chart perspective set up. So as of the most recent bar close prior to European morning trading session for the Friday, it was the Thursday 10-11 bar. So this bar. So again, you see the market comes up, gets traded lower, gets up. You know, it's again a bit iffy. So when a time frame is iffy, you drop to the next step based time frame, which is a shorter time frame, thus illustrating or depicting a narrower duration of time that the market had auctioned over. So you get a bit more of a clearer perspective. So if we drop to the 8-hour, which the 8-hour bar closes at 7, which is the European money trading session, we'll see this is poised very nice for downside. You see it comes up and then it's bearish. It looks good to keep pushing lower. So the same for the 7-hour. This bar closes at 6, which I'll still remember. I'll look to determine the most probable direction the market is likely to head in as of 6 to 7 UK time. And this bar, it was poised short term relative to short term 7-hour structure and keep pushing lower, which the 8-hour backed up. And this also shows the reality of how the 12-hour chart perspective market had actually auctioned like by looking at how lower time frames, what make up the 12-hour structure, are set up. So the 4-hour time frame was set up beautifully to keep pushing lower, which it also, if we go to the CFD time frame, which we can see this 4-hour bar closes at 6. The futures market time frame, which I'm aware is still a CFD platform, but active trades issues CFD time frame bar closures. The market also relative to the CFD feeds was also set up very nice for downside. So just sorting out this. Yeah, so, and it actually looked a bit better on the CFD feed. But anyway, yep. So as of the prior bar close relative to 2-hour time frame to European morning trading session, this time frame looked like it was going to keep pushing lower, and it did make sense to go on the short side. And then if we go to see how the 1-hour time frame is set up, which I know this isn't a word in the English language, but I call it dictatory, which is basically the dictating time frame. I look to assess how the market is set up relative to the 1-hour, how the 1-hour chart perspective has auctioned like over the time period running up to European morning trading session open, and then based on how the time frames the next step higher was set up, what would be the most sensible or appropriate way to look for the 1-hour chart to set up like, and for it not to set up like, to go on side to the most probable direction the market is likely to head in as of European morning trading session, which was downside. Now, as we'll see, relative to 1-hour structures, what I mean by that is like the at-hand push legs. So for example, just to illustrate what I mean, this would be an at-hand push. So I'll just mark it up instead of like saying, oh, well, this, and that would be an at-hand push, etc., etc. So this is like the big picture at-hand push, right? And then these are like short-term structures. So as of hang on. Right. For fucking hell's sake. So as of 7 in the morning, the market had like we see an at-hand push hard came to fruition on the run-up to 7 a.m. that the market was sat trading right at the very lows of that price range defining the 1 hour at-hand push. Now, we don't want to be selling markets that are sat at the very lows, right? Yes, it is likely for the market to keep pushing lower, but we need to look for the 1 hour. We need to determine the most probable or most appropriate way, not probable, the most appropriate way to look to deal with how the 1 hour chart is set up to go on side with the high time frame direction. Now, it would be important to look for the 1 hour chart to set up right, because the 12 hour we'll see where we're sat right at the very lows. The daily will also, I'm still on the screen, by the way. I'm just going off my head because I can also remember it from the Friday, because I extensively look at how the market is set up, and I've been doing this for quite a long time, literally since the June. So the 12 hour was sat right at the very lows of a healthy candle quantity, quantity and quality, meaning like healthy candle quantity comprised within the at-hand 12 hour push, with each bar in the at-hand push comprised of a healthy price coverage, those candle quality. So yeah, it would definitely, yes, although the market is likely to keep pushing over European morning trading session, we still need to look for the 1 hour chart to definitely set up right, especially when it's sat at the very lows, because bullishness could take hold. It's not likely to, but this is why we need some confirmation on our side, right? So if we just get rid of this shit, we see that the market's trading at the very lows in the parabolic hill zone relative to 1 hour time frame chart perspective was kind of bullish. So based on how the high time frames were set up, what the most optimal way to deal with how the market was set up was look for a 15-minute first initial intent exhibit of the day bar close at this region. Now that's a concept of mine. At the end of it, it's just what I call it to help remember myself. Basically, it's like a bar like this, right? It's like a bar that kind of shows somewhat rejection to go the opposite way, and just show that you're not going to get steamrolled, put some odds in your favor that you're not going to get steamrolled. Of course, if that bar unfolds, you've got no idea how subsequent market participants will end up pairing up with the prices that define the market, right? Of course, these are the CFD feeds, so it doesn't matter how people on active trades trade with these prices, because the prices that you're seeing from active trades are derived from the futures market or interbank market, right? So, but primarily the futures, right? Which is of the 6B. So, relative to the futures market, which is the 6B, this is time frame. So, as of the point in time of 7 in the morning, relative to the futures time frame chart perspective, the market was trading at around 130.50, just around that area right now. However, participants pair up and trade with those prices dictates how the subsequent market auctions like. So as of this time period, when you get this first initial intent exhibit of the day bar close, I'm aware I'm rambling quite fast and I said that wrong, but as when this bar closes, it's a first initial intent exhibit of the day bar close, which remember you would only be looking for to form anyway under the right contextual circumstances. So this is just forming at fucking at 5 in the evening, not at any key time period. And plus, it's like, so I'm just explaining what a first initial intent exhibit of the day bar close is, right? And the point is if this did form at this region on the 15M time frame, after that, whatever prices define the market, for example, in this case, the prices were defining the market, meaning the best bid, best offer, was situated around 130.79, around that area. Now, how participants pair up and trade with the contracts placed bid and offered at that region and point in time, dictates how the subsequent market auctions like, and therefore the structure that unfolds. So if they buy up each of the offers, right, they will facilitate the market move higher. And if they keep buying up the offers, then you'll get steamrolled anyway, but you just like some odds in your favor. So if we go back to the chart, I'll then drop to the 15M time frame, and also I didn't want this 1 hour at hand playable range prior to this at hand playable range to be at hand pusher structure to be closed in. So like I didn't want, for example, because we're sitting right at the market was auctioning relative to 12-hour time periods right at the very lows. If the market came exploded down to here, of course that's subject to whether participants take those actions that'll facilitate that price movement. If they did, I would probably call it a day. But anyway, I'd be just observing that, and I'd wait for this region of prices to be traded to. Now, from the 7 in the morning. Now, as we see, the market didn't trade to the downside, and it just stayed contained within the region of 7 of the prices what are available as of 6 to 7 in the morning. And then as the market is traded here, I would look for a first initial intent exhibit at the day bar close, which we got right here. But that isn't a sufficient anatomic bar close for me, appropriate for me to go short on. So I'd keep waiting. I stopped looking for trades after the 10 a.m. bar close. That bar still wasn't sufficient. This wick, the wick to the downside was larger than the wick to the upside. And then here, this was sufficient. And then I just went for a 20 point stop. This wick was larger than the wick to the downside. It was a nice compact 1 hour 15-minute anatomic bar close, and it had a sufficient 15M playable range, as we see right here, and it was right at the highs. And then I just went for a 20 pip stop, which was most contextually fitting for me, and then I closed profit right down here, as you see on the prior YouTube video that I had done. And I closed on all of my accounts once I had exited on my phase 2, my 2 funded, and my phase 1, which is almost past my phase 1. So yeah, there we go. That's how the market was set up as of this day, and that was the approach that I undertook.